If you are currently keeping your emergency cash, your future house down payment, or your hard-earned savings inside a traditional bank account right now, in 2026, you are unknowingly participating in the biggest financial scam of the modern century. Let that sink in for a moment. The banking industry has spent billions of dollars over decades marketing a massive, highly calculated lie. The comforting narrative that a savings account is the safest, most responsible place for your hard-earned money. They built giant stone buildings with massive vaults just to visually brainwash you into associating their institutions with absolute security. But today, I am going to peel back the curtain and reveal the dark math behind why your bank is actively using your loyalty, your fear, and your hard work to make themselves staggeringly rich, while leaving you at the bottom of the economic food chain with nothing but melting purchasing power. By the end of this video, you will understand exactly why your savings account is a dangerous psychological trap, and you will learn the precise 3-step modern alternative that you must execute today to protect and multiply your financial freedom. The comfort of logging into your banking app before bed, looking at a stable, unchanging number, and breathing a sigh of relief is an incredibly dangerous illusion. It feels safe because that number doesn't fluctuate like the volatile stock market, and it doesn't crash overnight like the crypto markets. It gives you a false sense of control. But here is the brutal, unvarnished truth. While your nominal balance, the absolute number of digits on your screen, stays exactly the same, the actual real-world value of those dollars is dying a slow, painful, and guaranteed death. Every single day that your money sits idle in that vault, the central banking system prints more currency out of thin air, systematically diluting the global supply of money. Think about what this actually means for your daily life. It means you are running as fast as you can on an economic treadmill that is actively moving backward. You are working longer hours, putting up with corporate stress, sacrificing time with your family, skipping luxury items, and aggressively cutting coupons. Yet, despite doing everything right according to old school rules, you are falling further and further behind. Your vehicle for safety has secretly been weaponized into a vehicle for absolute wealth erosion. Let's look at the cold, hard math that commercial banks deliberately hide behind slick marketing campaigns and complex financial jargon. Let's map out a realistic scenario. Imagine you have worked incredibly hard and managed to stack a solid balance of $25,000 sitting inside a standard, traditional savings account. You feel proud and you feel secure. Currently, the national average interest rate for a conventional bank savings account hovers at a pathetic, insulting 0.06%. Let's do the real-time calculation. After a full calendar year of letting the bank hold your money they immediately turned around and lent out to hedge funds, institutional investors, and corporate developers to generate massive profits. The bank gracefully deposits a grand total of $15 of interest into your account. $15 for a whole year of your loyalty. Now let's factor in the real-world cost of living. The true, unmanipulated inflation rate, which realistically sits around 4.5% for everyday essentials like food, insurance, healthcare, housing, and energy. Because of that inflation, that exact same $25,000 worth of lifestyle and goods today will require $26,125 to purchase just 12 months from now. Let's look at the final balance sheet of this safe decision. The bank gave you $15, but the invisible tax of inflation stole $1,125 of your hard-earned purchasing power. You didn't make a bad investment, you didn't lose it in a sketchy internet scam, and you didn't spend a single dime on yourself, yet you are literally $1,110 poorer in real, tangible wealth. If you leave that money there for just 7 short years, that $25,000 will lose nearly a third of its total utility. You are losing a brutal wealth war simply because you are refusing to step onto the battlefield. Step 1. Execute the maximum baseline strategy. To break free from this trap, we have to re-engineer how we view cash. Cash is not an asset class. Cash has only one legitimate purpose in the modern economy: tactical liquidity. It is a defense mechanism, not an investment tool. Your first task is to open up a spreadsheet and calculate your absolute bare minimum: survival living expenses, rent or mortgage, basic food, utilities, and core insurance for exactly 4 months. Not 5 months, not 6 months, and absolutely not a penny more. This specific number is your maximum baseline. Once you have this number, strip it completely away from your primary checking account and place it into a specialized high-yield cash account or a high-quality money market fund that yields a competitive 4% to 5% interest rate. This ensures your emergency fallback is at least fighting back against inflation. But here is the critical rule. Once this specific bucket hits its mathematical cap, you lock it down. You completely freeze all future deposits into this account. Any extra dollar that spills over this baseline must be instantly redirected into the offense. Step 2. Transition into a modern fractional asset owner. Once your tactical survival baseline is fully secure, your entire psychological goal must shift instantly from saving currency to accumulating equity. You must systematically and aggressively migrate your excess capital out of fiat currency and into broad market index funds, low-cost exchange-traded funds, ETFs, and short-term, short-duration treasury bills. The core philosophy driving this step is a concept called compound velocity. When you hold paper currency, you are holding a liability that the government can print at will. But when you buy into a broad market index fund tracking the top 500 global corporations, your wealth is directly anchored to the pricing power of the world's most dominant businesses. Think about it. When the costs of raw materials rise, companies like Apple, Microsoft, and Amazon do not just absorb the loss. They instantly raise their prices for iPhones, cloud subscriptions, and prime deliveries to protect their margins. Their corporate profits grow, their stock valuations scale, and consequently, your net worth goes up in lockstep. You completely stop being a helpless victim of inflation, and you suddenly become a direct, wealthy beneficiary of it. Step 3. Build the automated wealth flywheel. The final step is eliminating human emotion from your wealth generation. If you rely on your willpower to manually transfer money into investments every month, you will eventually fail. Life will happen. An expensive vacation will tempt you, or market fear will paralyze you. You must set up a system where your checking account automatically sweeps any amount above your maximum baseline on the first of every single month directly into your chosen productive assets. By automating this velocity, you practice dollar cost averaging. You buy more shares when the market is cheap and fewer shares when the market is expensive, completely removing the dangerous urge to time the market. You turn your income into a relentless, automated wealth flywheel that builds freedom while you sleep. Now, whenever I explain this framework, the traditional fear-based counter-argument is always exactly the same. But what if the stock market crashes tomorrow? My traditional savings account has a rock-solid government guarantee up to $250,000, while investing in the market is incredibly risky gambling. This deep-seated financial fear is the exact psychological mechanism that keeps the middle class trapped in generational survival mode. Let's address this fallacy directly and logically. Yes, the stock market experiences short-term corrections, emotional pullbacks, and periods of macro volatility. That is a natural economic cycle. But if you analyze any historical rolling 10-year window across modern financial history, a diversified basket of the global economy has a near-perfect track record of producing highly positive, inflation-beating net returns. When you choose to leave your wealth rotting inside a traditional savings account, you are making a conscious economic trade. You are trading short-term emotional comfort for a 100% guaranteed, mathematically locked, long-term loss. Let that sink in. Volatility is nothing more than temporary price fluctuation. It is not the same thing as a permanent loss of capital. The true terrifying risk in 2026 isn't a temporary dip in the stock market. The real risk is the guaranteed silent destruction of your family's purchasing power by sitting still and doing absolutely nothing. To visualize this perfectly, I want you to think of every single dollar you earn as a highly trained, lethal soldier in an economic army. Leaving your money inside a traditional savings account is the exact strategic equivalent of taking your entire army of soldiers, marching them into a dark, reinforced concrete bunker and locking the heavy steel doors forever. Inside that bunker, your soldiers are completely safe from enemy gunfire. No one gets wounded, no one gets lost, and absolutely nothing changes. But while your army is sitting idly in the dark, playing cards and wasting time, the enemy is outside on the terrain, systematically capturing your territory, burning down your farms, pillaging your resources, and cutting off your vital supply lines. Your army is technically safe, but they are slowly and inevitably starving to death inside their own haven. Investing your money, on the other hand, is the act of strategically deploying those financial soldiers out onto the battlefield. Yes, it requires tactical planning, and yes, there are inherent operational risks involved. But it is the only mathematically possible way to capture productive territory, win the macroeconomic war, and secure your long-term sovereignty. It is time to stop letting your financial soldiers starve to death inside a dark banking bunker. To permanently escape the modern savings trap, you must fundamentally rewrite your internal financial operating system and reject the outdated advice of the previous generation. Let's summarize the blueprint we covered today. First, cap your liquid emergency fund to a strict, non-negotiable 4-month survival baseline using automated high-yield cash accounts. Second, immediately transition your mindset from a passive cash saver to an active fractional asset owner. Third, automate your investment infrastructure so that every single spillover dollar is instantly deployed into high-velocity, productive equity. And finally, always remember that in the modern economic matrix, asset owners dictate the terms of society while cash holders are forced to pay the bills. The current economic system is fundamentally designed to reward those who own productive assets and heavily penalize those who foolishly store paper currency. The choice of which side of that divide you want to be on is entirely up to you. If you are ready to stop being a passive victim of the traditional banking trap, and you are ready to start building real, undilutable generational wealth, hit that subscribe button right now. I want you to drop a comment below immediately and tell me, what is the current interest rate your primary bank is giving you on your savings? Let's look at those numbers together, expose the reality of the banking system, and build a community of sovereign asset owners. Thank you for watching, and I will see you in the very next video.